Okay, this is Richard Ainsworth. This is the Director's Lecture Series. This is the second one for this year in 2014. We're here in room 209. I've got the residential program with me, and the online program is out there listening on a delayed basis. You'll get a transcript of this lecture. You'll be able to see the audio. You'll be able to save the video. You'll also be able to get a transcript of this lecture. This is a two-part lecture. There's two parts dealing with China, because China is an important issue for transfer pricing for us and for many Americans that are dealing with cross-border situations. Frequently, the taxpayer would like to establish something in China, and they would like to maximize the profit in certain low-tax jurisdictions. So this is the first part of a two-part Chinese presentation. It'll be in English, it won't be in Chinese. Because something very important came out, the UN transfer pricing, practical manual on transfer pricing for developing countries. It came out in May of 2013, and in chapter 10.3, there is material that the Chinese tax administration submitted. So a little bit of background. What's happening in China, or what's happening with the UN transfer pricing manual? The UN decided to get a number of developing countries together and figure out how to do transfer pricing. Because developing countries have a problem with transfer pricing. It usually requires a considerable amount of expertise in order to do transfer pricing. Normally in the United States, it's a combination of lawyers and accountants and economists that are doing your transfer pricing work. The difficulty for a developing country is sometimes you might have an accountant, but you don't have a lawyer, or you certainly don't have an economist, and the research is difficult to do. As a result, at least from the developing country's perspective, they may have been taken advantage of by developed countries designing a transfer pricing scheme that's a little bit more sophisticated than a developing country can deal with. So what the UN did was they got together a number of countries from developing countries that had ideas on how to do transfer pricing. And this is the intent to deal with transfer pricing in a developing country's budget and education background, how to do it more effectively for developing countries. China believes it has some solutions. China believes it has some approaches to transfer pricing that's been helpful for China and might be helpful for other countries. Now, for an American or for somebody dealing with American transfer pricing, this is a concern because it means that the American approach to transfer pricing may not be the Chinese approach to transfer pricing or some other country that's following the Chinese approach, and you may have a methodology that's not going to be acceptable on the other side of the transaction. So if there's an American company in relationship with a Chinese company, you have two audits going on. You have the US audit trying to determine how much income should be earned in the United States, but you've got the Chinese audit trying to determine how much income should be due in China. And if the Chinese are working with a different set of rules than the Americans are working with, you need to be aware of their differences, and you might need to solve some of these differences, or you certainly need to take it into consideration when you're proposing a transfer pricing plan. So there was a major change in Chinese law that was effective in 1/1/2008. Now that's a while back, but this was a big deal for China. Previously, in the prior law, there were two systems. There was one system set up for domestic taxation and a separate system set up for multinational enterprises. So the foreigners paid one rate and the domestic folks paid a different rate. The domestic rate was higher than the foreign rate. This was maybe to encourage foreign businesses to relocate into China. So the effective tax rate was 14.89% for multinational enterprises. This got harmonized in 2008 with the enterprise income tax law that came out, published in 2007, effective 2008. There are implementing regulations that are out. They're in Chinese. There's good English translations for them. They came out in December of 2007. And then there's Circular 2, and I'm not going to do the Chinese, but there's Circular 2, which gives some special implementation measures for tax adjustments. So this is the base material that came out at the end of 2008, 2007, and the rules have been in effect. We weren't really sure what was happening. when the new rules came out. And it's only now that we're starting to appreciate what the Chinese approach to transfer pricing is, particularly the UN manual helps us a bit. Prior to 2009, the Chinese approach was to substantially follow the OECD approach. That's the Organization of Economic Cooperation and Development. It's a group of countries that are developed countries, not developing countries. So that is essentially your problem, is that the transfer pricing rules for the longest time have been sponsored by the developed countries, and they have been perceived as taking advantage of the developing countries. And China, prior to 2009, was following the same set of rules. So China, a developing country, was following the developed countries' transfer pricing rules. And so there's been a shift a little bit after 2009. You see in circular number 2, when it comes out in 2009, it takes a different approach to transfer pricing regulations. Now, fundamentally, what we do in the United States is we issue regulations, and most of the other developed countries issue regulations that explain to taxpayers how to determine what the transfer pricing is. That's not how it happens in China. The Chinese regulations aren't written with the taxpayer in mind, they're written with the auditors in mind. So they're writing regulations to themselves. They're writing regulations as a developing country to auditors that are working for the Chinese government to explain how the Chinese should be doing their audits. So there's not quite a direct communication between the Chinese tax administration and the taxpayer. Different approach from what the US does and other places do. Other things are also starting to become clear, differences between China and the West. China does not have as much of a problem with secret comparables. We're always trying to find out what the price is between one party and another party that are related parties. And because they're related parties, they can sort of fudge on what the prices are. And the auditor will come in and say, well, I don't really think this is the correct price. The price should be something a little bit different. And if the auditor says, I believe the price should be 15 rather than the price being 10 because you've reported it 10 on your return, we'd like to have the price 15. You say, well, why should it be 15? It says, well, other people are charging 15 for almost the same product in exactly the same market. And you'd like to say, who are those other people that are charging 15 for the same product? Because I'd like to check this out. The Chinese approach sometimes is, well, we can't tell you what those comparables are. You just have to trust us that the price is 15, it's not 10. That's kind of a problem, and that is a problem for developed countries. However, there is a good reason for it in a developing country is they don't have necessarily a lot of data, or they have the data from prior audits that they've done on these companies. So secret comparables seem to be acceptable in China. Secret comparables are not acceptable in the OECD model or in the United States model. That's very different. Dependent comparables. There's no express prohibition to dependent comparables. A dependent comparable means Coca-Cola has a subsidiary and the subsidiary is wholly owned by Coca-Cola, and I want to know what the price is between Coca-Cola the parent and Coca-Cola the subsidiary. I can't go to Pepsi-Cola the parent and Pepsi-Cola the subsidiary because that is a dependent relationship. Pepsi-Cola can control the price between Pepsi-Cola and Pepsi-Cola subsidiary, just like Coca-Cola can control the price between Coca-Cola and Coca-Cola subsidiary. So generally in the developed countries, dependent comparables are not acceptable. And there's express prohibition. You can't use dependent comparables. We don't see that express prohibition in China. Could be a problem. Capital intensity adjustments are not used in China. That means you have to make an adjustment if something has an awful lot of capital employed in it versus something that has an awful lot of labor employed in it. In the UN chapter, in the manual that came out in 2013, 4 very specific things became important. Number 1 were location-specific advantages. The Chinese have an attitude about location-specific advantages that is very different from what we see elsewhere. I'm going to talk a little bit about that and show you what a location-specific advantage is. For example, cheap labor in China is a location-specific advantage. Why do you go do your manufacturing in China? Because you can employ 100 people for the same price as you could employ 10 people in the United States. So there is an advantage for going to China, low labor. Well, if there's a low labor advantage in China, then maybe China believes it deserves the profit from that location-specific advantage. There's premiums from the Chinese marketplace. They would like to secure their premiums. There are products that when they are sold in China, because they were made someplace else, like a BMW in China has a cachet to it, more so than a BMW in the United States has a cachet to it. So maybe the Chinese pay more to get a BMW in China. The market premium comes from the people in China willing to pay more. Should that profit stay in China or should it go back to BMW? Royalties for Chinese research and development. There is research and development that's being done in China, and the research and development is creating intangibles, and the Chinese are concerned, should we get the profit returned to China for the creation of intangibles that are really created here in China? Are these Chinese intangibles, and there's a royalty reserve for it? There's a high technology status that's available in China. If you go to China and bring high technology attributes to China, you can get a tax break. And some people go to China in order to get the tax break because they're going to bring in high technology. However, on your transfer pricing, you might not want to say there is high technology in China because then there would have to be royalty payments. So there's a problem between going for your tax break and recognizing in your transfer pricing what you should do with the technology status. So there is new transfer pricing documentation requirements. There's the 9 forms that are going to be filed. They're listed in Circular 2. Do you have to file transfer pricing documentation? Do you have to do a study to prove to the Chinese that the transfer price between the United States and the Chinese subsidiary is the correct price? Do you have to do this work? And when do you have to do it if you have to do it? Well, you are exempt from a transfer pricing study if you have below 20 million Chinese currency units in intercompany transactions during a year. So if the relationship between you and your Chinese subsidiary is fairly low in terms of the gross sales that are going between the US parent and the Chinese subsidiary, then you don't have to do a transfer pricing study. This number is reasonably low. However, there's a middle group that is subject to transfer pricing documentation, but not necessarily before the return is filed. Now, the standard in the United States is if you have a transfer pricing issue, you need to present your transfer pricing documentation in almost every case before your return is filed, because you've got to explain why the price is 10 instead of the price being 15. But in China, you don't have to have the transfer pricing documentation if you exceed intercompany transactions above 20 million currency units before the return is due. You can file the return and do the transfer pricing documentation afterwards. However, what is closer to the norm is if the transfer pricing, if the pricing between you and your subsidiary in China exceeds 20 million Chinese currency units, then you have to have the transfer pricing documents done before you file the return. So the return has to say, based on these studies, the transfer pricing should be 10, not 15. Right? So the rules aren't straight, and they're eliminating the low transactions. But think of an American company that has a relationship with a Chinese manufacturing company. Take, for example, Apple Computer, that has a whole lot of their material manufactured in China by an independent third party. And so this is not a transfer pricing problem, because the independent third party that's doing the Apple manufacturing in China is dealing in arm's length with Apple in California. What would happen if on a particular day, Apple decided to buy out the Chinese company and make it a wholly owned subsidiary? Immediately, you've got a huge number of cross-border transactions, and the value is probably in excess of 20 million currency units. As a result, as soon as you do the buyout, you've got to have a transfer pricing study, because your return based on this relationship is between related parties, and it's over the threshold. And so some companies wind up buying their distribution subsidiaries in China and forget to say, these are related parties now, and I have to have my transfer pricing study, and they have problems with the Chinese return, and they never really thought about it for the buyout. The people were all concerned about buying out the subsidiary. They're concerned about buying out the distribution subsidiary in China, but they weren't interested in the transfer pricing study. So this huge tax issue developed immediately. So here's the basic idea of transfer pricing. This is really simple down. If there's a parent company and a subsidiary company, and the parent company buys raw materials at 25 and does something to it and manufactures it, sells it to its wholly owned subsidiary, 100% wholly owned subsidiary, and the subsidiary then sells to a third party, then the total profit the guy in blue makes, the parent plus the subsidiary, is the difference between the sale price on the way out, which is $250, and the purchase of the raw materials on the way in, which was $25. There is $225 of profit made by this group, the two blue squares, the parent and the subsidiary. The question is, how much profit was made by the parent and how much profit was made by the subsidiary? Well, because I control the subsidiary, I can control the price between the parent and the subsidiary. I can control where the profit is. So transfer pricing is about what is that price between the parent and the subsidiary. So if the price between the parent and the subsidiary is 75, I purchased something for 25, I sold it to my subsidiary for 75, then the profit in the subsidiary is 175. And the profit in the parent is 25. Now, if the parent is in the United States and the subsidiary is in China, then I've got huge amounts of profit in China and not so much profit in the United States for exactly the same transaction, where if I had changed this price to 125, then the profit in the United States would be 100 and the profit in China would be 125. This is transfer pricing. How do you know what the right price is between related parties? Now, this is an easy related party situation because it's apparent that 100% controls their subsidiary. If you have 100% control, you have 100% control over the price. You can manipulate the situation so that your profit flows from the United States into China or from China into the United States. Or if you're really crafty, one of these entities is in a tax haven. And they don't have any taxes there. So my incentive now is to move as much profit as I possibly can to the place where there aren't any taxes and to keep as low profit as I can in both the United States and China. So I can insert a third entity someplace in here and dump as much profit as I could in the Cayman Islands or Bermuda or some other place. That's what transfer pricing is about. How do I know what this price is? Well, the best way to find out what the price is to find somebody else that's just like the parent, selling to somebody else who is just like the subsidiary, but not a related party. I don't want Coca-Cola sales to Coca-Cola subsidiary compared with Pepsi-Cola and the sales to Pepsi-Cola subsidiary. I would like a manufacturer selling to an independent third party because this reflects the arm's length. This reflects the price in the marketplace. This reflects the fair price that should be charged. So transfer pricing is all about how do I find out what the devil's price is that's going between related parties. So in transfer pricing, it's really simple. There's only two things. One question is, are the parties related? The second question is, how do I determine what the price is? Are they related parties? Now, related parties is the American term. It really means, are these parties so related to each other that they can control the price? That's the kind of related parties that I want. I want parties that make control of pricing the important thing. So the issue is control. Do you have the right to control the price? The United States approach to this control issue or to this related party issue is economics. Do I economically control the relationship? Do I have like a monopoly control over the price? It's an economic relationship. There's another way to determine control. It's legal control. Do I own them? Now, do I own them is different than do I control them? Because I can own them, but they can do what they want. But if I can prove actual control, that's a different question. However, it's a little bit easier to prove legal ownership than it is to prove economic control. Legal ownership, you hire a lawyer and somebody goes to the books and they say, well, you own 100% of the company, you control them. To do economic control, you got to hire an economist that's going to be able to prove that they control the economic relationship between the two of them. And in the United States, we would say potential to control, I can own you 100%, but you do what you damn well please, is not control. Because you have legal control, but you don't have actual control. We're looking for control, real control, really I control the price, and I exercise that control. That's different from just legal control. The OECD for the longest time was on this attitude that it had to be legal control, and we had economic control in the United States. And eventually we sort of worked with the OECD to persuade them that maybe the right approach to was closer to economic control. And the OECD and the OECD model is coming a little bit closer to where the US is right now. Where's China? We're going to see where China is in a minute, but they're not quite there where the United States is. Now that's an important difference, because the United States could say you do not have related parties, and China could say you do have related parties. In the United States, you don't have a transfer pricing issue, and in China, you do have a transfer pricing issue. There are methods. The methods, the standard approach to the methods are, there's the comparable uncontrolled price method, there's the resale price method, there's the cost plus method, there's the profit split method, and there's the comparable profits method, which the OECD calls the transactional net margin method. Almost the same thing, but not quite the same thing. Right? So there are these methods, and 3 of the methods are called traditional methods, or they're transactional methods, and 2 of the methods are called profit methods. There's a difference between them. If you really want to know about this stuff, you've got to take a transfer pricing course. However, China accepts all of these methods. They accept the words behind all of these methods, but they might have a different approach to some of these words. So we're on the same page, we're reading the same language, but we might not be interpreting it the same way. So, in China, what's a related party? Well, a related party is, number one, there's 8 different ways to be a related party. In the United States, there's only one way to be a related party. You're economically controlled, and you have an economist determine whether you're economically controlled. But in China, test number 1 is ownership. If I have 20% equity ownership of the common stock, I mean, that's a legal definition. This is old OECD stuff that's happening. And it's not 51%, it's 25%. The threshold is low. Now, some countries that use the legal relationship, they say, well, control is ownership of 51%. That's the Japanese rule. But that's not the Chinese rule. The Chinese rule is 25%. As a result, China is sweeping a lot more companies into related parties simply by test number 1. Test number 2 is senior management. Over 50% of the senior management or one executive on the board of directors. That's different, but that's like control because I control the management. Or debt. Not stock ownership, is debt ownership. So that the debt of one party equals 50% or more of the capital of the other. So I'm owning the debt, and they exclude banks and financial institutions from that. Or all transactions, and it doesn't matter, all transactions between a headquarter and a Chinese subsidiary. It doesn't matter what kind of ownership you have. Licensing of intangibles. If the normal operations in China are dependent on intangibles that are licensed from the parent, then you have related parties. Raw materials and spare parts, if the parent is buying the raw materials or selecting the spare parts or controlling the inputs into the Chinese manufacturing facility, you're related parties. Service or receipt determinations, one entity provides service that is determined by the other party. So the guy in China does work only when he's told to do work by the foreign entity. Do this research now. Produce this product now. And it's all service-based. Right? Or actual control. So I have a lot of different ways to be a related party in China. To be a related party in the United States is an economic test. You hire the economist, and the question for the economist is, do these guys control the pricing between these parties? If they do control the pricing, then you're related. In China, there's a lot of different ways to be a related party. So you have a difference between US and China. UN Practical Manuals, we are going to do 3 issues today. There's going to be a second lecture that's going to follow up this, which will get into even more details on what's happening in China. This is an overview of the 3 major issues. There's more to come. 3 issues for China are lack of appropriate comparables. China says it's really hard for us to find somebody that's comparable to this transaction out there. I mean, we're in China. We don't have great databases. We don't have access to a whole lot of businesses doing the same sort of thing. This is the first company that's doing this in China. I mean, they may be doing a whole lot of this in the United States, but this is the first guy in China to do that. We can't find any comparables to this. We don't have the database for it. So we're having difficulty there. The second thing that China says is the quantification and allocation of location-specific advantages. China says there are location-specific advantages. We want to quantify what they are, and we want to be able to allocate them between the domestic and the foreign enterprises. So that's an issue for China. The United States has problems with this location-specific advantages. We like to say there aren't any, lots of times. And then there's problems in identifying and valuing intangibles, particularly intangibles that are created and developed in China. So, issue number one, this impacts the methods. So, all OECD methods, except for profit splits, require comparables. So we had 5 methods. All of those methods require comparables, except for profit splits. Hello. All of these methods require comparables except for profit splits. So you know where we're going. China says there are difficulties with comparables. As a result, the inclination in China is profit split because I don't need comparables because I don't think there are good comparables. The inclination in the United States might be different because we do have access to good comparables. So right away at the beginning, there's a structural difference inside of these methods that we've developed. And the methods are, in the Chinese view, biased towards developed countries that have good comparable databases and biased against developing countries which don't have those databases. As a result, we would prefer, when we have a problem, to do a profit split, which is a different method maybe than the method that's being used on the other side of the transaction. So, developing countries have limited data, limited numbers of public companies. They can have a first mover. This is the first guy that did this stuff in China. How can we find any comparables? Nobody else is doing this, right? As a result, the developed country comparables are being used. So you find a company from the United States that can't find comparables in China, and the Chinese can't find comparables in China because he's a first mover in China. And we have to do our transfer pricing analysis, and we don't really want to do a profit split because profit splits tend to allocate an awful lot of profit to the places where the intangibles are, and the Chinese are going to say they've got a lot of tangibles. So we use a different method, and we use a different method based on comparables. And those comparables are being generated from a database that doesn't have a lot of Chinese companies in it because it's not good data from China. As a result, what happens is a transactional net margin method will be used, and the comparables will come from China. No, they'll come from Korea, a developed country, Japan, a developed country, Australia, a developed country, New Zealand, a developed country, because that's where the data is. And somebody is going to say, well, the whole world is one big happy global place. Everything is the same. There's globalization. There's free movement of capital everywhere around the world. So what's the difference between Japan and China? What's the difference between Korea and China? What's the difference between Australia and China? And you have to say to yourself, yeah, we didn't put the plant in China. We did put the plant in China because we didn't want to go to Japan because it's different. It costs more in Japan. There's regulations in Australia. We went to China for a reason. So there's a fundamental disconnect here in some of the transfer pricing stuff where they say our comparables are including other countries in the region, in the geographic area, because they're in the same geography, they should be producing comparable stuff. And then you say, but we didn't go to Australia to put the plant in the subsidiary. We didn't do our marketing out of Australia. We didn't do it in Japan. And the reason we didn't do it in Japan was because there were advantages to go to China. And China's saying those are location-specific advantages. No, so not only do you need to recognize location-specific advantages, in addition, you have to change your methodology. Because if your methodology is dependent on finding comparables and there is no database to finding comparables in China, then we are stuck with a profit split. All right. So if adjustments cannot be made, if you've got a database that's out there and you say these are comparable companies, but they're not quite comparable, they're almost comparable, it just happens to be in Japan, it just happens to be in Korea. The rule is not that you reject those comparables in some situations. The rule is you make adjustments. So you need to get your database from someplace, and if the database doesn't square with what you're finding in China, you need to make adjustments. But you need to make adjustments for the cost of labor, you need to make adjustments to the cost of electricity, the ability to get raw materials. You might have environmental protections that are really high in Japan, but much lower in China. So you've got to make adjustments for those. You've got to get somebody that does those kind of adjustments, who's probably an economist, and say, based on the difference in environmental protection in China and the environmental protection in Japan, what would the effect be on a price between a related party, between the United States and Japan versus the United States and China, based on the impact of the different environmental regulations? If you can't make those adjustments, what happens? Do you still have a comparable? Well, there's two different attitudes to this. The OECD transfer pricing guidelines have been out for a long time. So if you go back to 1979, to the transfer pricing guidelines, there is next to nothing about comparability back in 1979. But in 1995, there is some material on comparability in the OECD rules. And it says, to be comparable means that none of the differences, if there are any, between the situations being compared could materially affect the condition being examined in the methodology. None of the conditions, nothing between these two parties can affect the price. If you do have differences, and they just happen to be in Japan, but there are no other differences outside of geography, the guys in Tokyo versus the guys in Beijing, that doesn't affect the price. The telephone rates may change, the electricity rates may change, we can adjust those, but if none of the other remaining differences affect the price, then you're comparable. Then in 1995, they said, in all cases, adjustments must be made to account for differences. The OECD in 1995 said, in all instances where there is a difference, you must make an adjustment. There are some countries around the world that still like the 1995 OECD rules. Do you have a comparable? Well, there are some adjustments that have to be made. Did you make the adjustments? Yes, I made the adjustments in all possible places that adjustments were made that will affect the price. Yes, you still have a comparable, even though there's some differences between the parties that you're comparing with the subject transactions. The United States didn't like this approach because it says if you cannot make the adjustments, you don't have a comparable. If you don't have a comparable, you don't have a method. If you don't have a method, you don't know what the price is, you can't make the adjustments. And you're stuck with a profit split. So after a bunch of years of talking about this stuff, by the time I come to 2010, the OECD rules have changed where they're starting to say adjustments must be made in all places where they're possible. So you just have to say, we made all the possible adjustments. There are some adjustments that aren't possible to be made because of differences that we can't do. And the answer is you still have a comparable under the new OECD rules. This is an explanation of how the OECD is merging towards the US approach, because the US is making adjustments in all possible areas, but if they can't make adjustments, it doesn't mean you don't have a comparable. It means that you have a comparable, but it's not quite so good, but it's still a comparable. The old OECD approach said, if you can't make an adjustment and an adjustment needs to be made, you don't have a comparable, throw it out. The Chinese approach is a little bit closer to the old OECD approach than towards the current OECD approach, 2010. So, issue number one is comparables. Do you have comparables? If you take the approach that there are no comparables, you're stuck. You have related parties. You only have two things in transfer pricing. Are you related? What's the method that's going to change the price? Are you related? Yes, you're related. How do you change? What's the method that you use? Oh, I don't have any comparables. The answer is, I'm sorry, if you're related parties and you don't have any comparables, you have only one method left, and that's a profit split. That's a deadly approach to transfer pricing for an American company or a non-Chinese company that's used something else in their documentation elsewhere. So if I've got a Canadian company that's using something for their transfer pricing methodology and it is not a profit split, and I go to China, I am looking at an audit difference between between Canada and China. Because the Chinese are going to use a profit split, the Canadians have used something different, I've got a problem right away. So if you're a tax lawyer and you're working out there, you've got to be aware that there are differences. You've also got to be aware that there's some money to be made here, that you've got to have some friends in China or some friends in jurisdictions that are different from your jurisdictions, and you've got to coordinate. That's why you come to an LLM program that has people from around the world, because you make friends and you network, and you can call up somebody that was part of your class and you can talk to them about what the rules are in their country. They become really important to you. In addition, your fees go on for a little bit longer because you've got a much more complicated issue than just an American transfer pricing issue. You're not just reading IRS rules and regulations. You're reading IRS rules and regulations, finding somebody overseas who can help them with the foreign jurisdiction, and then when you have two different approaches to the price between the related parties, and your methodology comes out with the price has to be 15, and their methodology comes out with the price has to be 10, you do have a problem, and you've got to talk to your client and say, I've got 10 in China, I got 15 in the United States, and they're not the same. You're either going to pay over amounts of taxes in China or over the amounts of taxes in the United States, and we need to harmonize these approaches. You've got to come up with a better method, or we've got to find some way to make the Chinese number come to 15 or the American number come down to 10, so that even though I've used different methods, I come out with the same number between the two related parties. This takes a lot longer to do, which is good for business. So, issue number 2. This impacts the methods, which is location-specific advantages. Now, the Chinese have an approach to transfer pricing issues where they go in and do an industry. And they did automobiles like nuts. And they'll go on to another industry and do a whole bunch of other industries. They'll go in and do pharmaceutical industry and do every pharmaceutical industry in China. And then they'll go do somebody else and do all of that industry in China. Now, what happens is they get a lot of really good expertise in automobiles, but they don't have an awful lot of expertise in pharmaceuticals right now because they haven't done the pharmaceuticals. But they got a lot of expertise in automobiles. If you're in the automobile business and they have started to audit the automobiles, you've got a problem because you're going to have an audit, and it's going to be a good audit, and they're going to understand almost everything they need to know about automobiles. Oh, and you might have secret comparables because these same auditors were over at the BMW place, and they really understood the BMW relationship. And they're going to assume that if the BMW price is like this, then the Ferrari price has to be like this, and the Ford Motor Company price has to be like this. And they got a lot of industry knowledge. A lot of it might be secret, and you might not be able to get a hold of it. So, kind of a problem. Anyways, in the automobile industry, they say there are location-specific advantages. These automobile companies came to China for special reasons. One of them was a market that was favorable for technology. We had good technology infrastructure and they wanted it. There's a consumer brand preference in China because if you manufacture a BMW in China and it still looks like a foreign BMW that's controlled by the German BMW people, then the Chinese will buy this BMW even though it's made in China and might pay a little bit extra than you normally would for something that was made in China because it looks like it was made someplace else. There's an inelastic demand for automobiles, they say. There's capacity constraints on domestic supplies. There's not other people that are producing other sorts of competing products, so the price can go up. There's a savings on duty. If you bring it in, if you bring parts that were sort of prefabricated in Germany and they're going to be bolted together in China, there's a reduced duty savings that you're going to bring it in. If you bring in a whole car from Germany, the duty is higher than if you bring in pieces of the car and assemble it, right? And there's high quality and low cost parts available in China. They got another discussion about 50-50 joint ventures, where the Chinese partner will do the local distribution network. They'll have intimate knowledge of the market and the right place to market, and the foreign partner will control all operations, and they'll talk about these in terms of related parties. So in the automobile industry, they've done a lot of work with related parties. So I'm going to give you 2 examples. One example comes from the real world, but I took out the name of the company. The other example comes from the manual, and so you can read the other example in the manual. Right. Both are going to demonstrate how a transfer pricing methodology deals with location-specific example advantages from a Chinese perspective. I'm not talking about location-specific advantages from the US point of view, but I'm going to try to pretend I'm a Chinese auditor looking at a transaction, and I'm saying, this is the data that I get. Do I have a location-specific advantage, and how do I deal with that location-specific advantage? So, here's the company. So I got a parent company that's foreign, maybe it's in the United States, and it has a relationship with a subsidiary that's wholly owned in China. Now, I'm not concerned with are they related parties. this problem assumes they're related parties, so it's a 100% owned subsidiary, and it does control the entity, so it's a related party for US purposes, a related party for Chinese purposes. So I look at if you don't like numbers, this is probably not a happy place for you, but there are a lot of numbers. But if you wind up doing transfer pricing as a lawyer, you need to have a friend who's an accountant. Because in order to do transfer pricing, you've got to have a lawyer's aptitude, you've got to have an accountant's ability to run through a bunch of numbers, and you've got to have an economist's ability to understand the marketplace. So this is a three-team affair. This is not just one guy doing it by himself. So I look inside of the Chinese company. This is all in Chinese currency units, and I find that I've got sales, I've got cost of goods sold, I've got taxes, I've got gross profits. The real numbers are over on the right-hand side. Right? I got selling expenses, administrative expenses, asset losses, and operating profits. And in this particular case, the pricing between the parent and the subsidiary was determined by an operating margin ratio. This is an example of what the United States would call a comparable profits method. It is what the OECD would call a transactional net margin method. I'm going to try to allocate the profit between the parent and the subsidiary by using a profit level indicator, and the profit level indicator is operating margin. This says that in similar comparable companies in the same or similar functions, when they do things between the United States and another country, I have an indication of profit, which is my operating margin. My operating margin is defined in the terms of the formula as H, which is the operating profit, divided by A, which is sales. So I say, if I take my operating profit and divide it by my sales, I get a ratio, and the ratio here is 1.54%. So I'm looking at my company, my related parties, my parent and my subsidiary, and I say, what's the operating margin? The operating margin is 1.54%. When my sales go up, my operating profit goes up, and the ratio between sales and profit is 1.54%. My question is the pricing between these related parties, the parent and the subsidiary, correct? Is the price, I don't know what the pricing is, but is this pricing correct? Does the pricing allocate the profit in the right way? Because my profit in China, in this instance, is significant, but it's 1.5% of the sales. So what I do is I go out to other countries. Because I got a problem here in this example, because this is China, and I don't have a good database, but I got to find some comparables. So in this example, in this real world situation, this big accounting firm went out and accessed a database, and the database says that there's other companies doing similar sorts of things out there, and these companies have a profit profile that you can use in order to determine what the prices should be between these related parties. And by the way, the parent and the subsidiary are in blue because they're related parties, and the others down here are in green and red because they're unrelated parties. These are not related parties. This is not Pepsi-Cola selling to Pepsi-Cola subsidiary compared with Coca-Cola selling to Coca-Cola subsidiary. This is independent parties selling arm's length to another party, but they're doing it across a border. And I do have a good database. Trouble is, every one of these are from developed countries. Now this is going to drive the Chinese nuts because they're saying, geez, we're not like Korea. We're not like Japan. We're not like the UK. Even though you found these other companies out there that are sort of related in the same way, there's fundamental differences. We don't even think these are comparables. But if we can get over the hump of their comparables, that's what the American approach was to find other developed countries with these companies in it and assume that this is what the pricing is going to be. So what I do is I go to all of these companies out there, 1, 2, 3, 4, 5, 6. I found 6 relationships that seem to be comparable. And I take the operating revenue divided by the operating profit, which I have to do the operating cost divided by total cost, and I get my operating margin. So what I do is I find my profit level indicator for all of these 7 companies, and I say, based on this, I do a range. And my range of operating margins goes from 12.21% down to 0.59%. So I've got a spread of what these 7 companies are. I find the middle of where the spread is, and the middle of the spread is somewhere between 2.5% and 0.76%. And I say, well, I found these other 7 companies that I felt were comparable, and if they were comparable, and if you believe this, then the 1.54% is right here in the middle. This is a good price. The amount of profit that's being made by the blue subsidiary is the appropriate amount of profit because it's making profit based on the profit level indicator that works in this industry. Now, of course, if you're attacking this from the other side, you say, well, one of these relationships aren't comparable. Let's throw them out. Another one of these guys isn't comparable. Let's throw this guy out. So if what you're doing on the audit side is you look at the 3rd company down, which was a profit level indicator of 12.21%, you throw him out of there, and then you go to the next one, which is 3.8%, you throw that one out of there, and then you throw the 5.14% one guy out of there, and you say, because they're not comparable, they're not in my range, I can't use them for data, and all of a sudden this 1.54% becomes out of the range. So the argument in audit becomes, are these guys comparable, or are they not comparable? And the Chinese are going to say there's a lot of companies that aren't comparable because they're not in China, because you can't make the adjustments for making them comparable. They're going to take the old OECD approach. So if you buy this previous example, that I have found something that is proving to me that 1.5% in the pricing between the related parties, the 2 blue parties, is correct, how flexible is this? Well, what would happen if I removed $500,000 in administrative expenses? I removed administrative expenses from China. In other words, I increased the profit in China by removing administrative expenses. I had the administrative expenses done someplace else. What happens to the percentage? Well, the percentage goes to 189%. 189% is still in the middle. That's fine. I can play with my numbers now. If you buy the fact that I have established what the correct price is and the correct profit allocation between the companies, I can now remove administrative expenses from China. Increase my profit in China, put the administrative expenses someplace else. Now what happens if I remove selling expenses of $2 million and administrative expenses of another $1 million? Well, the number doesn't move very much. It moves to 3.97%. 3.97% is still in the middle. So I can move expenses out of China, or I can increase profits in China by moving the expenses to some other place. Some other place might be a high-tax jurisdiction where I need more deductions, and it stays the same. The transactional net margin method allows me to make decisions about where to put my expenses. Oh, what happens if something different happens? What happens if all of a sudden these Chinese people decide they love this product that was made by this company? They like it so much they're willing to pay a premium price for it. So if instead I increase my sales number by 10 million, what happens? Well, when the sales price goes up by 10 million, my transactional net margin method tells me my operating margin is 7.92%. 7.92 is outside of the range, and I've got a problem. Now, this is what happens, is all of a sudden the Chinese start paying crazy amounts of money for my stuff, and I make too much profit in China. Who deserves the profit? Do the Chinese guys deserve the profit because the Chinese people are paying more money for this stuff that I'm making? Or do the Americans deserve the profit because the Americans found something that the Chinese really want to buy? Who deserves the extra 10 million? I mean, that's what we're fighting over. Who deserves it? The Chinese are crazy. They're paying too much money for this stuff. But that's all right. Where are you going to put the money? Well, the Chinese are going to say, hello, they bought it in China, we're going to keep it in China. And the Americans are going to say, wait a minute, they only bought it in China because it was a great idea. We had all this promotion stuff going on. We want to take it back to the United States. So if you go to the annual reports of this company that I dragged these numbers out of, which is where the transactional net margin method came from, you find in the annual report that there's a relatively constant sale of this particular item all around the world. Sales are the same everywhere. Nothing's really much changed in sales. However, there was a significant profit bump in China. Only in China. The Chinese went nuts over this thing and they bought these things. So they could charge lots more money in China. The annual report tells you that the Chinese went crazy over this stuff and paid too much money for it, probably. Sales didn't increase around the world. Sales didn't increase radically in China. The Chinese just started paying more for this stuff. Right? Faced with this evidence, a U.S. foreign auditor would probably believe that the transfer price for the product sold to the Chinese distributor was too low. The United States is going to try to suck back as much of this profit as it possibly can because the transfer price was wrong. We didn't charge these Chinese guys enough for it, even though they're our own subsidiary. We should have charged them more because we should have been able to bring this profit back to the United States. Right? Oh, Chinese auditor is going to say the opposite. Chinese auditor is going to say, wait a minute, the profit was made in China because the market in China was paying a heck of a lot more for this product than you normally would pay, and we want to keep it in China. Right? Oops. So what happens is, in order to move the price back down, what the U.S. would want you to do is to increase your cost of goods sold. That's the red number that's in there. So if I increase my cost of goods sold by 10 million, because the sales went up by 10 million, the cost of goods sold is coming from the United States, then the 10 million goes to the United States. When the 10 million goes to the United States, the ratio drops back down to 1.44%. My transactional net margin works. The Chinese went nuts and they bought too much of this stuff, but the profit came back to the United States because I increased the price of the product going from the United States into China. Our Chinese would do it differently. The Chinese would say that extra 10 million of profit belongs in China because it's a market-specific location advantage that we got in China. The argument that's in the UN example is similar, but it's not as complex as the one that I dragged from the real world. What the example in the UN model says, if there's a parent and a subsidiary, and there's an R&D subsidiary in China, and the only thing that's coming back to the United States or to the developed country is research, then the profit level indicator, in this instance, they're going to use the full cost markup, which is essentially a cost plus. So whatever your costs were, you're going to mark up those costs, and the markup on the cost is going to be the profit that that foreign entity is going to make. So the research and development subsidiary in China has a cost of 100, and it's going to have to make a profit in China. The profit's going to be based on a markup. So we're going to pay not only the costs of doing the research and development in China, we're going to pay a markup of 1% above that for China, and that's your profit level indicator, fixed cost markup. What you do is you go out and find 7 other companies that are other places doing research and development. Of course, you're not going to be able to find too many Chinese companies doing the research and development because this is a new thing in China. But you're going to find them in Japan, you're going to find them in Korea, you're going to find them in the United States, you're going to find them in Europe, you're going to find them in Germany, and you're going to use those people as your comparables. And you say, these other companies have a 8% markup. So based on what everybody else charges for their markup based on cost, 8% is fair. So China, costs are 100 plus 8, it should be 108. But you look at it and you say, wait a minute, but the cost base was higher over there. It was 150 times 8%. And the costs in China were 100. Why did we go to China? We went to China because the costs were lower. And the Chinese are saying, I'm sorry, you came to China because the costs were lower. There's a location-specific advantage for being in China. And taking this 8% from the developed countries and applying it to the cost base of 100 only gives us 8. We deserve more. How are we going to get more? We're not going to get more by increasing the cost of labor because then people aren't going to come to China. What we're going to do is we're going to get more by increasing your percentage. So even though you've determined based on your external studies that 8% is the correct markup, what we're going to do is look at the cost-based difference, which was 50, because it cost 100 in China to make the same research and development that it cost 150 to do the research and development in Germany. Then the cost difference between Germany and China was 50. The cost base is 100. So we're going to have to increase the percentage from 8% to 12%. We like your 8%. That's really good. But in China, the percentage is going to have to be 12. Why is the percentage 12? Because 12 will allow us to get our location-specific advantage, which was the cheap labor, which is why you came to China in the first place. So if you're doing this work and give them a fixed cost markup for your answer, which a lot of CPAs do, if you are from the US side and determining what the price is using a fixed cost markup and you give the Chinese an 8%, and they come back and explain to you that really you don't have any good comparables and we're going to increase your percentage because you came here for the cheap labor. You came here because there's a special advantage for being in China. So Thank you for the 8%. We're going to increase it to 12. We're going to increase the amount of tax you have to pay in our country. Be careful. Sometimes in these transfer pricing audits, you're giving a loaded gun to the other side. You told them that you liked 8. You didn't consider location-specific advantage. They say, we like the 8, location-specific advantage, change it to 12, pay us the money. So, issue number 3, impacting methods, intangibles. Location-specific advantages are often related to market intangibles. Technical intangibles decline in value over time. In other words, the guys that made the iPhone may have had a really neat idea and stuck it in the iPhone, but it doesn't take too long before somebody else figures out that's a neat idea and I'll do exactly the same thing. So technical advantages decline over time. Apple has a lot of technical advantages. It's located in the United States, but the technical advantages decline over time. Market advantages go the other way around. China's got this massive market out there. There's tons of people in China wanting to buy your stuff. Market advantages increase over time. It's a bunch of treasury regs dealing with dual intangibles. When you get dual intangibles, you are right in the middle of a profit split, because the value of the intangibles is how you determine where the profit is. If you've got market intangibles in China and manufacturing intangibles or creative intangibles in the United States, China is going to start to get more money as time goes by and the U.S. gets less money, because the value of the intangibles in the United States are declining over time, and the Chinese value, once you get established, everybody wants an iPhone in China, everybody buys an iPhone. So, Chinese believe that royalties for intangibles should be adjusted over time. That's the commensurate with income standard in the U.S. regulations. China likes that idea. You don't set an intangible and just leave it there. You set an intangible and you adjust it, and you adjust it, and you adjust it. So, practical issues and solutions. This gets a little bit too technical, but there's an aggregation and separation issue. China will do both. So if you can see this in the U.S. regulations on aggregation versus separation and how those rules work, China likes that. Contract R&D. In a contract R&D situation, China will prefer a profit split over a cost plus. If you've got research and development going on in China, they really don't like this plus that you're adding to things. They would really prefer that we value the intangible in China, value the intangible in the United States, and do a profit split. Particularly with things that are high and new technology status. High and new technology status is a tax break that you get in China if you bring in intangibles. Lots of people like the tax break, but the flip side of the tax break is you've got an intangible in China and they're going to value it in your transfer pricing methodology. So if you're working in a tax department, be careful for adopting too many tax breaks in China for bringing in intangibles, because your transfer pricing adjustments are complicated. So there's a contract versus toll manufacturing situation. The toll manufacturers, the Chinese say there's next to no comparables to this, so we're going to have a different way of doing toll manufacturers. Sales, marketing, and distribution, there's always a mismatch because the Chinese market is different from the Japanese market, it's different from the Korean market, and the sales are different, the distribution network is different. So all of these things are really different in China versus other places. So alternative methods to the transactional net margin method. The favorite method in the United States for doing transfer pricing is the comparable profits method. The favorite method for doing it is comparable profits method. The other word for this is transactional net margin method. If you go into a company and you look at their transfer pricing, it's almost always comparable profits method or transactional net margin method. Chinese hate the transactional net margin method. Most developing countries don't like transactional net margin method. Example of electronic manufacturing company that's stuck in the regulations. The entire business is contract, toll manufacturer in China. This is almost like Apple Computer. Risk-based pricing doesn't work. There's a whole lot of work done on where the risks are in businesses. And what the Western folks like to do is take the risk and move it to the United States, and the developing countries say the risk is where the work is done. So there's a difference on risk analysis. Contribution analysis they do in a lot of these countries as opposed to the transactional net margin method. It's a formula that you look at the whole chain of what's being produced and you find out what the value is in the chain. They would prefer a contribution analysis. They would also prefer a residual profit split almost any time except a transactional net margin method. So China's solutions, this is the end. China's solutions to what the West has proposed for transfer pricing is really, we have to talk about location-specific advantages, because the reason you're here is because we have location-specific advantages. That's why you came. I'm sorry. You've got to pay for the location-specific advantages. You can't get the location-specific advantages and the profit from that and take it out of the country. You got to leave it here. Trouble is, when we go to the transfer pricing regulations, they just didn't happen to write these regulations with us in mind. They wrote it with something else in mind. Market premiums, you don't respect market premiums very much in your transfer pricing regulations in the OECD, but we think there is a market premium that's paid in China, and we would like to keep the profits from the market premium. That's a problem you're going to have, and alternate methodologies are going to start showing up in the audit cycles because they particularly don't like certain methods that we use in the West. The thrust of this whole lecture is, if you think about the world like an American and read the American transfer pricing regulations, I'm sorry, half of your transaction is happening outside of the United States, and it doesn't mean that those other guys agree with you. If you've got a transaction between the United States and the UK, there's a really good chance the guys in the UK are going to agree with you. Between the United States and Germany, maybe the Germans are going to agree with you, because they're sort of on the same sink. They're probably dealing as a developed country. But if you're doing transactions between the United States and China, and in all honesty, guys, a lot of the work is done between the United States and developing countries. It does not mean that the guys in China think like Germans, and the guys in China don't think like UK guys, and the guys in India don't think the same way either, and the guys in South Africa don't think the same way, and the guys in Brazil don't think the same way. They have different approaches to transfer pricing because you're taking advantage of certain things in your transfer pricing that are the exact same things that the companies took advantage of, and that's why they're here. That's it.